The Fed hands down a rate decision today, and mortgage rates almost touched 7%. First time we've seen that number in 2026. So let's talk about all of it, the applications data, the earnings, new law, why it's all happening, and what it means for the market. This is your midweek update. Let's go. First, what moved the most? Rates touched 7% this week on daily quotes for the first time all year. Now, Freddie Mac's numbers, they lag typically. They come out on a Thursday. So the last quote we had from Freddie Mac was 6.58%. It just lags behind a little bit from what we typically see. So why is it moving? That's the big question we're getting, and that's what we're looking at for the rest of this year. And the answer is pretty straightforward on this one. Oil spiked again on Middle East tensions, and that pushed our inflation expectations. Again, that pushes the 10-year, and then that mortgage rates slide based on the 10-year. So on top of all that, we have a Fed decision at 2 p.m. today, and what we're expecting is it to hold at 3.5 to 3.75%. No new dot plot came out this morning. Their statement language on inflation is what moves the fund rate tomorrow, right? Not the fund's number itself. Now, that number leads our closed sales by 30 to 90 days on new purchase applications. And here's the one that would surprise you is that even with rates touching 7%, purchase apps came in up 3% year over year this week. That's better than the 0.2% that we were sitting at the week before. Demand didn't crack because of a scary number. It held. Now, yes, the seasonally adjusted purchase index fell 4% week over week, and the overall composite dropped 6.4% as refi pulled back down. Refi has been a tough market since all the rate increases anyway. But that weekly wobble is rate shock, right? It's not year over year. Purchase read is still the one that tells you whether the real buyers are in the market. And right now we're seeing that they are. Now, on a national level, the here and now demand and supply balance. Pending sales came in at 70,748 this week versus 70,609 the same week last year, which is flat. New listings hit 73,109 versus 71,521 from a year ago, up about 2%. Inventory's building. We've talked about this in our monthly market report inside of our membership site. We've talked about this multiple times. Sellers are listing at a slightly faster clip than last year, and the buyer absorption is sticking near the same. There's just more inventory coming out. So that's a balance. It's not a buyer market forming overnight. It's not a 2008 type bubble happening at the moment. Inventory is up nationally, 865,233 this week versus 860,407 a year ago, up about 0.5% year over year. It's still loosening. Again, we're shifting in that more inventory kind of status at the moment, but it's not a flood. So what do we know from this when you're having conversations with clients or just in general in the market is that demand typically holds below 6.5%. It gets shaky between 6.5% and 7% mortgage rates, and then it really struggles above 7%. So we spent part of this year above that line on the daily rate, and purchase apps have still improved year over year. That's a market with more resilience in it than the headline numbers suggest. So watch the Fed language today and tomorrow's Freddie Mac print, because if that daily rate holds at or above 7% past this week, like if we're still in this higher rate of limbo, that tells us whether the resilience is going to start cracking. And I would anticipate seeing that showing up in the coming weeks as we go into the fall months. So now let's dive into real estate specific news. Two numbers came out last week that are still shaping what you're seeing on the ground right now. First, new home sales. Census said June came in at a 628,000 annualized pace, right? Up 1.6% from May, but down 5.6% from a year ago. Median price actually fell to 398,000, and builders are sitting on 9.3 months of supply. So again, the headline number doesn't tell you really anything. A balanced market runs about 6 months of supply. Builders are carrying 9.3. That's real inventory pressure. And it's why the median price dropped even though list prices barely moved. Builders are not cutting their sticker price. They're buying the rate down. They're eating the cost themselves. They have incentive packages out the wazoo. If you listen to their earning calls, you'll know this, that it's quite a few, and they're not backing down on that. That's a lever for your resale market down the street. They don't have that type of leverage on them, right? They have a low interest rate on their property. They're not under pressure to give incentives or back off their pricing, even if there's more competition in the market. So right now, new construction is outcompeting resale on the monthly payment, even in the same rate environment, that we just talked about. So if you're working with clients who are cross-shopping a resale property versus a new construction property, it's not an opinion, it's math. You need to ask what the builder's rate buy down is, what it actually does to payment, what closing costs look like, what other price reductions can you get. There are incentives that are built in, and then you need to compare that back to the resale because the math's going to be very different on the two at the sticker price. So that's the new conversation. It's not new construction feels overpriced. Work out the math on the deal. Second number that came out, and I already have talked about this quite a few times because I have seen it making its way around the interwebs, and that's foreclosures. They're up 21% year over year. Before you let this ruin your week or someone else's week or one of your clients' weeks, that 21% is measured off a historic low, meaning we were at the lowest point you could possibly be, and then we've started having foreclosures come back into our market. A lot of that was due to forbearance ending last year. Those are starting to work their way through the system. So in 2008, the homeowners, you have to remember, were underwater, negative equity, forced to sell at a loss, or hand back the keys. Today, equity is still sitting at record high. We covered this in our monthly market read, and what we saw was that appreciation, especially on resale properties, has just marched upward, even in the face of higher interest rates and lower buyer demand, or a throttled buyer demand, a tougher real estate market. Appreciation on resale is doing quite well. It's the new construction side that's getting hit a little bit harder. So this is just a normalization of an artificially low floor, not the front edge of a crash. Now, let's go to the upstream side of all this, which is the world that I live in, and that's the land market, past the MLS to where the dirt itself gets priced. Two big things this week, and they connect each other more than anyone's really saying out loud. First is earnings. We've had quite a few earning reports this past week. We have D.R. Horton came in this week, and that's one of the big ones in the country. They're the largest builder. We tend to follow them. I always say if they get a sniffle, the rest of us get a cold. And right now, they beat estimates for the quarter. Earnings per share of $3.20 against a $2.97 consensus. Margins came in at 20.7. That's above their guidance. So on paper, that's a good quarter. Now, what's going on under the surface? Cancellations jumped 20% from 17% year over year, and management cut full year guidance, citing softer demand in May and June. So the beat wasn't from selling more houses. It came from Horton pulling back and protecting margin instead of chasing volume. That's the country's largest home builder pumping the brakes on purpose and not just having a strong quarter. So let's talk about the other side of the spectrum, their land arm, which is Forestar. Now, I know Forestar, separately owned company, yada, 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 but they do the bulk of their land deals are through D.R. Horton. So they missed their side by 70 cents against an 81-cent estimate. Revenue missed 2, stock dropped 7%. Not amazing, but this is what they did not do. They held their full year guidance. They did not trim down like D.R. Horton did. So they're not seeing the softening that Horton is seeing on the demand side for housing. So they held their full year guidance at 14,000 to 14,500 lot deliveries. That is a massive number, by the way. And management said flat out that the finished lots remain slightly undersupplied in most of their markets, even as overall development activity slows. That should ring a bell if you're a developer. That should make you start thinking through what's the next 2, 3, 4 years looks like. We're already looking at that inside of our membership groups. So basically what the country's biggest lot developer had a rough earnings print, but they're not flooding the market with dirt to chase a bad quarter. Their supply discipline is holding even though their number missed. So here's the actual signal for you. The builder is slowing down. The land developer is not panic discounting lots to compensate. That's a supportive setup for land values, not a warning sign, even in a quarter that looks soft on the surface. And the second item, and this is something that we saw come through, there was some chatter about it before it happened, but I haven't really heard anybody dig under the surface on what this could mean in the future. And that's the 21st Century Road to Housing Act that became law on July 11th. I mentioned it twice now in a few other videos, and here's the piece that should matter. So Section 1001 of the law, literally titled, "Homes are for people, not corporations." It bans large institutional investors, defined as anyone controlling 350 or more single-family homes, from buying any more existing homes. Did you catch that? Existing homes. Penalties run up to $1 million per violation or 3 times the purchase price. That is nothing to sniffle at, especially when you're talking about it in volume. This takes effect 180 days after enactment. So sometime after January, we set that to see or set that to come into enforcement. So here's the part that changes your market, or you could see impact your market. It carves out a clean exception for build to rent. Institutions can still buy or build brand new single family houses built specifically for rental and hold them indefinitely. There's no forced sale. There's no sunset clock. This just prohibits them from picking up existing housing stock. So this law won't shrink institutional capital in housing. It just reroutes it into another sector. So starting next January, the resale channel closes for the big players. That's great. If you're a first-time home buyer or you're a local investor, it means that you'll have more opportunity in the actual resale space. The only lane that's now open to that capital will be new construction and build to rent. So that's the whole mechanism that you should be paying attention to. So what does that matter if you've never sold to an institution in your life? Because the single family rental operators that had their earning calls, Invitation Homes, AMH, are already sitting at the table bidding on the same finished lots as retail builders. That's exactly why Four-Star can say lots are undersupplied even while retail demand softens. Law is about to push more of that institutional bid toward new construction lots, not less, right as the resale door is shutting on them. So you need to pay attention. If you're entitling or holding land that pencils for small lot or attached product in a build to rent friendly location, there are parameters about that. We talk about that in the membership group. There are places that these guys hunt at, and they have intermediaries that help them hunt in those locations. You have a federally created tailwind, is how I view this, where they're looking for a specific product type for years to come because they still have capital to deploy. So watch for site plans and rezoning that could potentially allow you to skate to where the puck is going, not to where it's been. So if you skip to the action and feel like watching the whole video, totally understand that. Basically, rates touched 7%, demand held anyway. Builders are pulling back on purpose while their land arms hold on supply. And a law that's been sitting in the news for 3 weeks just quietly rerouted institutional capital straight towards new construction lots, which our land arm said are undersupplied already. So we expect all that to come to fruition and create some tailwinds over the next 3 or 4 years for the development side of the business. So if you're an agent, a broker, a limited partner trying to get your arms around all of this, and you're still finding out about all of this from a headline after the fact, instead of the mechanism behind it, you're going to keep on being a step behind anyone else who watches this video. I have a great tool. It's the off-market land kit for anyone who is interested in learning the front end of all of this on how to value a piece of land, how to source the land, and then how to potentially take it through entitlement and figure that piece out. We see that's where the puck's going. So if you want to skate there, feel free to go to it. It's located at deepdirt.co. It's free. It shows you the source land, everything before it ever hits the MLS, how to score the parcel. Go pick it up, go check it out. Anyways, thanks for watching, guys. And we're going to have one of these again next week.